Point to a negative open. European equity markets then are set for a negative open. Futures for the European indices index, the European index is certainly pointing to the downside, expect to be down by around 0.7% perhaps on the FTSE. That is what the FTSE futures suggest. Maybe losses a little less on the CAC carry-ons. The CAC futures down around 0.3%, DAX futures around 0.6%. So as we get into these markets, let's reflect on some of the drivers that we've got moving things around here. Concern around fiscal stimulus in the US, concern around the underlying virus, of course, as well. All of these factors, reasons to be cautious, but that didn't stop the S&P at least trying to top its closing record, failing, but trying to top and not far away from its most recent closing record last seen in February. So lots of interesting dynamics still resulting in stronger equity markets despite all of the concerns. So we have the UK market opening down by 0.6%, the CAC carry-ons down by 0.4%, the IBEX down around 0.5%. So all in all, we are weaker across the Stock 600, down by around 0.3% right now. So European markets are opening lower. That is as the S&P 500 stopped short of a record as President Donald Trump upped the pressure on China over Huawei. And at the same time, Democrats attacked the president on a number of fronts at the start of their national convention. And that's just another one of the uncertainties that the market is dealing with right now. We spoke to Thanos Fanvakides a little bit earlier on, and he was reflecting on what the US election as it approaches in November, what that means for the dollar. He was saying there are some factors that would seem to be dollar positive, other factors that would seem to be dollar negative. And so there are some real unknowns in terms of where we end up putting the dollar, depending on what the result of the election is. So it seems very difficult to judge right now, he said, and so therefore he just expects a lot more volatility and gave us some suggestions how to hedge that. So that's just one of the uncertainties we're dealing with in global markets right now. A few of the individual stocks we've got in focus for you. I'll just recap where we are on some of those that we previewed in our stocks to watch. So Persimmon, Danny was telling us about the construction company and how it was faring. And we've got numbers, we got a share price for Persimmon, which is up by 2.6% right now. Marks and Spencer's also moves to the upside. That is up by just over 2%, in fact, as we hear about job losses, 7,000 positions to go at that UK retailer. BHP, interestingly enough, down by 1.2% and we've heard from the CEO of BHP in the last 24 hours. Let's get an update then on some of the news stories that we're covering here at Bloomberg. A First Word News update for you. Senate Republicans plan to introduce a scaled-back stimulus bill. That's amid a standoff over a new virus plan that's dragged on for weeks. Two Republican Senate aides told Bloomberg about the plan. Among other things, it would include $300 a week in enhanced unemployment benefits and additional funding for the U.S. Postal Service. But getting Democrats on board with a scaled-back plan wouldn't seem likely. House Democrats are planning to add $25 billion in funding to the embattled Postal Service. Sources tell Bloomberg the idea is to vote on the legislation on Saturday. It would prohibit cutbacks ahead of the November election. The Postal Service has warned that election ballots to many states may not make it in time for the election. Hong Kong leader Carrie Lam says she's having trouble using her credit card. That's after the US imposed sanctions targeting Chinese officials in the city. She was one of 11 hit by the move earlier this month in retaliation for the new national security law. Lam says the restrictions are totally unjustified. Israel says Bahrain and Sudan will likely be the next countries to make peace with Israel. They're expected to follow the United Arab Emirates, or UAE's, lead toward normalizing relations. Israel's president has invited the UAE's leader to visit Jerusalem. It's a trip that no other senior Gulf leader is known to have made since Israel's founding. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. We're getting some news coming through from Norway, and this is from the Sovereign Wealth Fund in Norway. We always look to what they're doing with their energy exposure in particular, but right now we're just hearing about their top line numbers. So Norway's wealth fund lost 3.4% in the first half of the year. No detailed breakdown as yet as to where exactly that money was lost from, but some of our most recent reporting has also shone a light on a governance drama over at that particular wealth fund. So we'll get further details as they drop onto the Bloomberg around where this wealth fund loss of 3.4% has come from. But of course, we have seen a huge amount of volatility in markets. Some have done well off the back of that, others less so as a result of COVID-19. Coming up, well, in fact, I was just about to say coming up on the programme, we'll speak to Simon French from Panmure, but actually Simon French is with us. Simon, very good to speak to you. So we've got European equity markets this morning, reflecting perhaps on the uptick in virus cases across Europe, on a failure to pass fiscal stimulus legislation in the United States. Does it sit strangely with you, Simon, that we're talking about being near record highs for US stocks right now when we're dealing still with a global pandemic and a great deal of political uncertainty?
Well, look, it would come as no surprise to any of your viewers that there's been a sharp decoupling between economic fundamentals and the equity market. That's not news. I think what is starting to emerge as we get more and more data is that there are clear winners and losers on a sector basis. We're seeing strength in a number of real estate sectors around the world, a rebound in retail sales quite significantly around the world. And a lot of that actually is what I would describe as diverted demand. So this is spending that has been constrained in other parts of the economy due to social distancing that is leading to earnings upgrades across some sectors where there is very much a V-shaped recovery, indeed going above year-on-year levels. But it's those weaknesses, potential defaults and write-downs across sectors where that demand is permanently impaired that means you've got a very, very split picture, both on terms of the economic picture, but also the underlying performance of risk markets.
Yeah, indeed. So that's an interesting way of looking at things. When you look at the lack of progress on the fiscal side in the United States, we're watching all kinds of developed markets and the extent to which they are prepared to continue to support, to continue to pay wage bills, to continue to supplement unemployment benefits. What are your thoughts on how important it is that the US manages to come up with a sequel, if you like, to the fiscal stimulus they've already put in place?
I think sequel is exactly the right way of describing this, but it is a difficult sequel. Like many films, like many albums amongst pop stars, the second version is always harder than the first. Why? Because actually there are increasing voices that fiscal support, rather than just being universal and effectively keeping the economy and the attachment between employers and employees in cold storage, is now expected to support a transition to what might be permanent shifts in demand. And therefore it becomes more nuanced. And in the case of the United States, the longer we go closer to November in the election, the more the politics that are always relevant in terms of bailout fiscal packages will become ever more salient. And I don't think, I have to put my hand up, I expected a deal to be done early in August in terms of a succession to the CARES Act. It hasn't happened. Bipartisanship seems in sort of short supply on Capitol Hill, and that's a real problem for households for whom their income gaining power is potentially permanently impaired. They need some state support to see them through.
Yeah, you're certainly not the only economist who was expecting that to come through over that time horizon, Simon. And some continue to tell me, look, this is an election year. No one's going to want to seem like the party that is standing in the way of supporting Americans right now. So you never know. There could still be progress. On the Markets Live blog today, they've been talking about oil prices and the likelihood of oil prices ticking upwards again. We're at $45 a barrel on Brent at the moment, and the team are asking, will we ever see $70 oil? We have OPEC and friends releasing a little bit more oil perhaps into the market than they were previously, but the demand story, very uncertain, I suppose.
It is. I'll answer your question directly. I don't think we will get back to $70. I still think there's a lack of cooperation at OPEC and non-OPEC levels. The issue regarding the oil market, and certainly from an economic standpoint, is it has triggered some quite significant inflation worries, particularly in recent days, and inflation protection has taken on ever higher costs. Not because I think people are seeing $70 and plus oil, but because the significant base effects in the inflation measure from a year-on-year change from very depressed levels at the start, at the back end of Q1 2020. When we get into 2021, those base effects might be quite significant. Oil will be the vanguard, but it may well be other softs, other demand-sensitive sectors that are starting to push quite a significant uptick. I don't think it'll be sustained because of weaknesses elsewhere in the economy, but certainly a real challenge for people to watch, or for policymakers to watch, trying to deal with what might be quite a significant bounce back in headline inflation.
Simon, stay with us. Simon French, Chief Economist at Panmure Gordon, with us for another conversation this morning. And coming up, we will talk about the UK. Brexit is back, it seems. Talks resume this week in Brussels, but with either side standing their ground and just 7 weeks to go until negotiations are set to end. Who will blink first? This is Bloomberg. Welcome back to the European Market Open this Tuesday morning, 13 minutes into a trading session that is weak for European equity markets, down 0.5%. The FTSE 100 and the FTSE MIB leading the laggards, both down around 8 or 0.9%. Let's get a Bloomberg Business Flash for you now. Some of the top corporate stories we're covering this morning at Bloomberg. Marks & Spencer's is planning to cut about 7,000 jobs over the next 3 months. That's after its business was hit hard under lockdown. Sales in the clothing and home unit fell 39% in the last quarter, and they've remained weak since stores started reopening over the summer. BHP is broadening its plans to exit part of its coal business and reviewing opportunities to shed aging oil and gas assets. It comes as new CEO Mike Henry is making an urgent push to reshape the portfolio of the world's top miner. The company is laying the groundwork for a transition to copper and nickel. That's to meet expected demand from renewable energy and electric vehicles. SoftBank has invested almost $4 billion into 25 of the world's biggest technology companies. The bets include Amazon, Tesla, Netflix, and Alphabet. SoftBank founder Masayoshi Son is expanding the company's investment activities as tech stocks near record highs. Last week, he unveiled a new asset management arm for the business. That is your Bloomberg Business Flash. On to matters Brexit, and Brexit talks resume in Brussels today. Just 7 weeks remain until negotiations are scheduled to finish on October the 2nd. But neither the EU nor the UK is yet to budge, with officials in both camps saying they're waiting for the other side to blink first. Simon French, chief economist at Panmure Gordon, has spent much time, like the rest of us, trying to make sense of the latest moves. They're still falling out around fish, about the Irish border, and about the role of the court in Europe. Simon, where do you see this sticking to markets? Do you see this as something that the pound and investors need to focus on as we head towards the end of the year? And will it be October, or is it more likely we get some kind of decision on December 31st?
So I'm hopeful that October will be the moment where the grown-ups are invited back into the room. It's good to talk with you about this. We've talked about this on and off for 4 years, and the history of Brexit negotiations between the UK and the EU is that there's a rhetorical battle, which sterling, certainly sterling dollar, has been heavily sensitive to claim and counterclaim from the two negotiating teams and political developments in the UK. In terms of where it goes over the course of the second half of the year, I think we've got to have another big public falling out between the negotiating teams, probably a threat, quite a significant threat, to walk away from both sides. But actually going into the fourth quarter, and I think October, the back end of October, when we get a European Council where the UK will be invited, and it'll be one of those late night ones where some of the concessions on the issues you mentioned, fishing, the level playing field, the role of the European Court of Justice, adherence to the withdrawal deal, the major sticking points, they get thrashed out. And that is where the opportunity comes to close some of the gap that sterling has generated over the last 4 years. We have a 140 target versus the US dollar and a 125 versus the euro. So some upside, but I think investors right now can afford to be patient.
Yeah, and in terms of what we're looking for as the months unfold, or rather as we head into next year, Simon, we've talked before about how we end up in some sort of constant transition, ongoing dialogue, a little bit like the Swiss relationship with Europe, constantly in flux. That sounds very difficult for business to navigate.
It is, but it's the reality of two big interdependent trading blocks having to constantly evolve their relationship. I mean, for many of your viewers who may be more familiar with dynamics between the US and China, there isn't going to be a stroke of a pen from Donald Trump, from Joe Biden, from Premier Xi that puts this away. This is going to be a constant trade dialogue between the two big economic superpowers that goes on for many decades. That will be the same with the UK in its relationship with the EU. Now, your question around how business navigates that, well, what you're looking for is some medium-term certainty regarding relationships, regarding equivalence, a level playing field, so that the rug isn't pulled away at short notice. So you recognise it's a dynamic negotiation, goes on well beyond December the 31st, but some near-term certainty allows business investment to be done with some degree of confidence.
How important is the Brexit outcome or the trade negotiation outcome, Simon, here in the context of COVID-19 and everything that the UK economy has been through?
Well, there's a real divergence of opinions here insofar as the flux generated by COVID-19, which is, to use that often overused word, it is unprecedented, certainly without precedent in the last 100 years economically. Can you hide the disruption of Brexit amidst such a massive other external force? That is one school of thought. The other one, of course, is that with an economy so weak, and this is in respect of both the EU and the UK, you don't want to be layering on further frictions, further adjustment costs. I think the politics is largely unchanged, to be honest, by COVID, for all the fact that it's dominated the headlines for the last 6 months. In the context of Brexit, I think it was always going to go down to some of the principles here that actually get compromised at the 11th hour through a negotiation. And COVID doesn't actually provide the air cover to do something fundamentally different.
Simon, thanks very much. Simon French, Chief Economist at Panmure Gordon. Thank you very much for your thoughts this morning. Let me get into what's happening with a couple of companies that we talk about a lot. That is Nokia and Daimler. And we've got a ruling from a court that was hearing a case brought by Nokia that suggested that Daimler had broken some patents that were owned by Nokia in terms of in-car communications technology. Daimler has lost this patent ruling over the Nokia mobile phone technology. Daimler is violating the patent owned by Nokia, according to the court that has now ruled on this. There is another headline that says that Nokia must now post a €7 billion bond to enforce the ruling. This, according to the court. We've yet to hear what kind of punishment, if that is the correct legal terminology, that Daimler will face as a result of this, or whether there's going to be some sort of ongoing legal process. We'll look for these headlines as they continue to drop. In terms of the market reaction, both of these stocks are moving to the downside. Nokia a little more than Daimler, but this is a falling market. So both of these companies moving broadly in line with market trends this morning. Coming up on the programme, job cuts at M&S. The British retailer is slashing 7,000 roles over the next 3 months. We'll get details next. This is Bloomberg. Welcome back to the European Market Open. 23 minutes into the trading session for this Tuesday, and European equity markets on the back foot. One stock that is on the rise, though, in London is Marks & Spencer. As it announced, it is cutting 7,000 jobs. The British retailer is making the reductions over the next 3 months after its clothing business was hit hard by the coronavirus lockdown. That adds to a growing toll of lost employment in the UK retail sector. Joining us now is Bloomberg's Deirdre Hipwell. Deirdre, good to speak to you. So why is the business cutting staff now? You know, this has been a long structural trend, I suppose, trouble for the high street.
Absolutely, and M&S in particular. I mean, M&S has been trying to turn around its business for the last decade. I think one of the reasons why they're doing it now, well, I think there's a number of reasons, but some of the main ones is the government job support scheme, the furlough scheme, as it's known here, is coming to an end soon. So I think a lot of jobs that have been supported now, companies are looking very closely at their costs. So I think that's part of the reason. But I think the main reason really is just the shape of trade that's happened here. Although the stores have reopened, people in Britain are still quite nervous about going out, and footfall to the main streets, to malls, are still down massively compared to where it would have been a year ago. So I think, retailers are having to cut their costs accordingly. But I also think there's a slight bit of opportunism for M&S in that they are trying to accelerate their transformation plan. And so I think they're thinking now is the time to take these job cuts.
I also wonder, Deirdre, if you appeal to a younger demographic that is very used to online shopping and was able to pivot there very quickly, perhaps you were a little more protected from this, although M&S should have been a bit protected by exposure to food, and food has been selling very well, as we know, over the pandemic.
It has. I mean, their food division has done well, but the big bugbear that M&S has always had to deal with is its clothing and home division, which is still a very sizable part of its business, and it's been trying to move more online during, for the past decade. But what they've been seeing during the pandemic crisis, is that more of their customers are turning to online shopping. So they've had to devote more resources to that. They're having to do more home delivery. So I think they see that as the shape of trade going forward, which means they're not going to need as many stores in the future. They've already announced plans to close about 100 stores, and I think this is part of this wider structural shift that we're seeing. We're seeing in British retail that was happening already, but has now been turbocharged by the pandemic.
And there's some big retail venues that we're talking about, aren't they? And perhaps expensive ones. Deirdre, thank you very much. Bloomberg's Deirdre Hipwell on the latest on UK retail. Up next on the programme, we'll talk about geopolitics, upheaval in Belarus. Thousands of workers joined mass protests against longtime ruler Alexander Lukashenko. We'll get the latest on that story, on the role of Russia, what Russia wants to see from this. We'll talk about that next with analysis. This is Bloomberg. Welcome back to the European Market Open, 30 minutes into a negative trading session for European stocks. On European equity markets, we are decidedly on the back foot, but maybe off session lows is the best I can offer if you're long. Stocks down by 0.5%. We've got the FTSE 100 down at 0.7%. US futures flat to negative. The Nasdaq futures are flat. Dow futures down. Let's look at things from a sector perspective. I've pulled up the GRR screen, and it tells me that the biggest losing sector is media, followed by financial services and oil and gas. In fact, no sectors are in positive territory. There's seems to be some unanimity of thought around this move to the downside. Let's get a Bloomberg First Word News update for you now. Here are some of the top stories we're covering this morning at Bloomberg. The Democrats are holding a virtual national convention to formally endorse the presidential ticket of Joe Biden and Kamala Harris. It started with a series of attacks on President Donald Trump. Former First Lady Michelle Obama delivered a personal endorsement of Biden, who served for 8 years as her husband's vice president. Canada's Finance Minister Bill Morneau has resigned. His exit comes after a rift with Prime Minister Justin Trudeau over the response to coronavirus and amid an ongoing scandal. Trudeau didn't immediately name a replacement, but sources tell Bloomberg it won't be former Bank of England Governor Mark Carney. The UK government has been forced into a U-turn over exam grades. They've agreed to let the results be determined by teacher assessments rather than through a controversial algorithm that had downgraded thousands of results. It comes in the face of outrage from both parents and students. Education Secretary Gavin Williamson admits there was, quote, unfairness in the system. Israel says Bahrain...
Morning, everybody. New order placed to sell short at for euro 118.927. Order placed, sell short 118.927. I think it moved too fast, too far. Let me see. And I will have to cancel this order. See? It's all about how this candlestick will end up or down. Yeah. Okay, we'll wait, yeah? I think we'll have a chance to execute. Still waiting. Anyway, guys, hope you had a good evening. New start, new day. And don't forget to get a strategy. If you don't use, if you're not our client or our customer, please subscribe to our channel. If you want to become a day trader, let us know what you want to find out. If you have a problem or don't understand something from our strategy, I'll be glad to help you. Okay, it's look like he just doesn't want to take my money, right? Let's wait a little bit and see what's going to happen. New short position open for euro at 118.927.
Welcome back to the European market open. 36 minutes into a trading day that is negative, but off its lows for European equity markets as Nasdaq futures flirt with the flat line. Let's talk about banking and a conversation we tried to bring you yesterday, but we'll see if we can do better today. Just like its European peers, Pan-African banking group EcoBank faced a sudden contraction of revenue and a surge in bad debt from the coronavirus crisis. Lagos-listed shares in the lender have slumped more than a third since their March high, and the bank, which has operations across 33 different countries on the continent, as well as offices in China, France and the UK, has also named a new chairman in the midst of the crisis. I'm pleased to say he joins us now. Alain Nkonchu, EcoBank Group Chairman, took over the role on June the 30th. So thank you very much for joining us, Alain. What is the biggest challenge that you have faced operationally with the coronavirus?
Thank you for having me. I guess one of the biggest challenges that we have faced as a group operationally was essentially to make sure that, the bank continued to serve its customer and clients, in a seamless way. And I am happy to confirm that this has more or less been the case. And we have been able to serve our clients, throughout this pandemic, and even, reduce the cost of offering that service to a certain extent. Now, obviously, with this kind of shock, comes the notion of the drawing liquidity challenge, and also, the vulnerability of the balance sheet. This is something that we assess, on an ongoing basis, and we believe that, somehow this crisis will essentially be transitory, and eventually that will find some medicine or vaccine down the road, which will allow us, to basically go through this low cycle. What will happen by and large, within this crisis? The world has faced a simultaneous shock from the demand and supply side, and which have actually brought those economies to a virtual standstill. And to back it up, government have had to expand, fiscally and in a different way across the board. This has also been the case in Africa to some extent, with the bilaterals providing some helps and also some deferred payment on loans. And we believe that fiscal expansion has gone a long way to help those countries for the very first time applying a countercyclical policy whereby central banks have actually been able to cut rates, provide additional liquidity. And this is one of the very first, situation where we see certain banks in countries like this one expanding, yes, at time of shocks. So now the question is, where do we go from here, with regard to the pandemic? And really,
yes,
we have
so you point out there some of the positives and some of the things that central banks have done to support the economies in Africa, but that still leaves you, no doubt, with a headache in terms of loans going bad, loans needing restructuring. What percentage of loans at EcoBank do you think will need to be restructured in 2020?
No, it's actually too early to assess that. And I think you also have to understand that within this kind of environment, it makes perfect sense to actually allow banks to give it a bit more time to see what will actually become, a structural impairment within their balance sheet, post, after we actually have a true measure about the economic impact, of this crisis. And the way we view it essentially is a twofold, right? We are in a situation whereby we are still taking advantage of, the fiscal expansion that has been provided to some of those countries, and discussing with governments, how the best trickle down they could actually offer within the real economy. And I believe, and we believe, at EcoBank that, this crisis will eventually be transitory, which means that some of those companies who are facing challenge will eventually recover. Now, that's one of our long-term view, but we also hope that this is actually going to be materializing very soon, which means that, between now and the end of the year, probably additional fiscal, measure will be needed to support those economies. And surely, central banks have actually offered some room of brief, to those banks in the form of, in a form of forbearance, which allowed banks to actually take some time to consider, how structural impact their balance sheet will be. And that's the process we are going through. And by the way, we view this kind of shock situation as an opportunity to basically challenge our capital in the most efficient way by sizing opportunities that are being left by, the constraint that some of the financial actors are having just because of the nature of the crisis. And we believe that, working very closely to some of our customers, we can actually have the best risk-adjusted reward, in terms of expanding our capital and helping those companies that we believe will go through this cycle.
Okay, and so Alan, you point to a lot of reasons to be hopeful there, and banks in Europe and the US are keen to cast themselves as part of the solution rather than the problem when it comes to getting through coronavirus. Maybe that's true of Africa as well, but maybe African banks will have to face some distress. Do you expect the banking sector to be somewhat distressed?
Listen, again, everything could happen, right? It depends on how long this crisis will last eventually. And obviously, if, within 2 years' time, we still haven't found any meaningful product, it's pretty clear that global growth will actually probably linger, after this strong rebound that we are facing. In which case, yes, you should expect, some damage, some permanent damage within the balance sheet of some banks, essentially also because, by and large, Africa is commodity driven, and which in this kind of situation would be less demand. So we have to make the contingency plan, to have to face a situation where, yes, we could face, some challenge within the balance sheet. But like I said, this is not our base assumption. Now, even having said that, we also understand that macro policy has been relatively helpful, but even in a situation like this one, they will need to actually still even more more expansion in order to actually cushion the impact of this crisis. So a lot of things still need to be done. But as a bank, we are still, in the wait-and situation with the view that this is actually going to be a transitory phenomenon.
Alan, thank you very much. Really good to get your perspective. Alan Nkonchu, the EcoBank Group Chairman, joining us here on the European Market Open. Let's get a Bloomberg Business Flash then. Some of the top stories, top corporate stories we're covering here at Bloomberg. Oracle is entering the race for TikTok's US business. That is according to the Financial Times. The move may complicate Microsoft's attempt to take over the operations. The FT reports Oracle may also partner with TikTok's US investors on a bid. They include General Atlantic and Sequoia Capital. Boeing is planning more job cuts than its original 10% target. It is preparing a buyout offer for employees for a second time this year. The so-called voluntary layoffs come as the plane maker tackles declining demand for jets. CEO Dave Calhoun says the layoffs are hard but necessary. Employees will get more details next week. As accidental payment at Citi is now heading for regulators and the courts. The Wall Street bank mistakenly paid about $900 million to lenders of Revlon. Citi described it as a, quote, operational mistake. Some have opted to return the cash, but others have not. Citi is now suing Brigade Capital Management, who, at least initially, refused to return the money. No comment from Brigade. That is your Bloomberg Business Flash. Back to the geopolitics now, and we will attempt again our conversation around Belarus, where thousands of workers joined mass protests against the president, Alexander Lukashenko, as we mentioned earlier. So what future here? What is the role of Russia? Let's get to our conversation with Alexander Baunov, Carnegie Moscow Center. He joins us now. Alexander, good to speak to you. So ultimately, is it up to Putin what happens here? What is it that Russia wants to see happen in Belarus?
First of all, Russia wants the union between Belarus and Russia to remain. Putin blames Gorbachev and Yeltsin for destroying the Soviet Union. The only thing that remained of this big Russian and Soviet empire is the union of Russia and Belarus. So what Putin wants to keep before he leaves is this, the last remnant of the union.
And what kind of support would you expect Putin to send to Lukashenko then?
That's an important question because there is a big difference between Ukraine and Belarus. In Ukraine, only a part of population is considered in Russia by the Kremlin and by the public opinion as friendly towards Russia. In Belarus,
I'm placing stop on profit for Japanese yen. We, as you can see from our ticker, we were holding two positions. We're still holding at 105.567 and 105.917. I put stop for both of positions at 105.547.
the half of Ukraine. You don't see anti-Russian and even anti-Putin slogans in Belarusian streets. That's the big difference between Kiev and Minsk.
Yes. And that seems to suggest that President Putin could be happy to see some kind of transition from Lukashenko to another leader. Is that a likely outcome?
Yes, exactly. If Putin intervenes in a brutal way, we can expect to see these anti-Russian feelings and anti-Russian slogans. So the best solution for him would be not to support Lukashenko, who is maybe lost already, but to find a form of smoother transition from not very anti-Russian Belarus to the future more democratic Belarus that will remain not anti-Russian and want to go immediately to join NATO and other Western structure of security. Can you hear me?
So will this develop into another election? Yes, Alexander, we can hear you. Will we see another election taking place then, or will this be a handover of power in another way?
The recount of votes is not possible because, as far as we know, a considerable number of ballots has been already destroyed. It can be what Lukashenko is proposing. Maybe is told to him by Putin personally or by the Kremlin. He proposes the changes of constitution, some mysterious changes of constitution that allows him to stay for a while and then to transfer the power to the next leader. Right now, the population, so the protesters, they represent, to my opinion, the majority of the population, don't accept this solution. So we don't know exactly which kind of transitional solution will be proposed. But in the interest of the Kremlin and somehow in the interest of Belarusian economy as it is now, with all these big Soviet factories, heavy industry, and so on, to find a transition that make Belarus democratic country, but keep strong ties with Russian market and Russian economy, because it's heavily depending. All these Belarusian heavy industries that gives the majority of jobs are heavily depending on Russian market.
Alexander, thank you very much. I'm very glad we managed to re-establish that line to you. Really good to speak to you and get your analysis. Alexander Baunov, Senior Fellow at the Carnegie Moscow Center. Thank you very much for joining us. Coming up on the program, what would it take to get oil back to $70? We spoke to one guest earlier on, said he doesn't think we will get there. We'll put that question to Christina Aquino, who leads our Markets Live team here in Europe. That's next. This is Bloomberg.
stop on profit for euro at 118,907. Okay, I'm placing stop on profit for 118,907.
Welcome back to the European market open, 52 minutes into a trading session.
And position is closed for euro at 118,907. We have 200 pounds in profit.
There's something of a very August feel to some of these markets, Christine, and yet we're talking about US equities, the S&P in particular, trying to take out all-time highs, which seems kind of astonishing when you think about all of the headwinds that markets face right now. Where do we think that US stocks are heading?
Yeah, it's a good question, Anna. And I think, you know, for the remainder of the summer, I think they're going to do what they do best, which is slowly drift higher in the absence of any solid catalyst. It is interesting that, you know, we've gotten a little bit of developments both on the stimulus front and the U.S.-China trade talks, just in terms of us knowing that these are going to continue and will continue to be risks for markets into the autumn, but not necessarily yielding any concrete results or developments as yet. And so I think in the absence of any major changes on those two fronts, stocks seem happy to just drift higher. It is interesting, though, that there is a bit of a contrast with some of the other risk indicators and other asset classes. We are seeing a bit more of a buildup in just a bit of risk aversion or tentativeness in FX, credit, and fixed income. And the question, I guess, is when the equity shoe will drop. It might not be until September.
Yes, indeed. And so if equity markets are quite willing to put the sell-off in March behind them, we don't necessarily see that elsewhere. Commodities is one of those places. And I know on the Markets Live team, you've been talking about when oil gets back to $70, or if it will, currently around 45. It went negative, as we know, but it's far from the 70 that we saw at the turn of the year.
Yeah, absolutely, Anna. And I think some of the responses that we've gotten pertain to supply, of course, and it's really crucial that the OPEC Plus group stays together in terms of their common goal of controlling supply. But of course, the other side of this as well is demand, right? And if people aren't flying, if there is reduced travel even by cars after the summer season, it's really difficult to see it getting back above those levels. And that's really what we need as well, is kind of both supply and demand doing the work here. And the OPEC Plus group could control supply as much as they'd like, but if the demand side isn't there, if people still don't have the confidence to travel as much as they did prior to the pandemic, that'll be really a tough call to get it back to 70 even by the end of this year.
Politics in the US is certainly topical this week, Christine. The Democratic National Convention taking place. We'll head towards Republican events, of course, as well. Volatility seems certain ahead of November, even if market responses to some of the events as yet to unfold is a little more unclear.
And I think it is the usual tack for markets and politics. It's one of these things that is difficult to price until it's very imminent, say in about a month's time out. And at this point in time, just thinking back to the 2016 election as well, it was a very similar setup, for instance, in the dollar, where it was languishing around year-to-date lows back then. And we didn't really see it motor higher up until, I would say, just weeks into the November 2016 election, which, of course, brought the ascent of President Trump to power, and that came with it expectations of all these changes that would spur U.S. growth. So we're kind of in a similar setup now in the dollar, where the summer before the election is kind of languishing near lows. We'll see how that plays out in November.
Okay. Christine, thanks so much. Christine Aquino from our Markets Live team. That's it for the European Market Open. Surveillance is next. This is Bloomberg.
Deadlock in Congress. Senate Republicans plan a slimmed-down stimulus bill, but Democratic support looks unlikely. European stocks trade lower. Competition for Microsoft. Larry Ellison's Oracle is said to be interested in buying TikTok's business in the U.S., while others join the contest. And the world's top miner, BHP, reports steady underlying earnings on a surge in iron ore. The chief executive, Mike Henry, speeds up plans to exit coal. We'll bring you our interview. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, the markets are, again, thin trading volumes because it is, of course, August, and here in Europe, a lot of people are still off or actually trading less than in the past. This is what I'm looking at overall. So first of all, if you look at the European stocks 600, they're kind of trading sideways. They're slipping somewhat. Certainly U.S. futures are, as gold is bouncing back. Now, the Trump administration stoked tensions with Beijing by announcing new restrictions on Huawei technology. That's maybe giving a bit of an impact or a bit of a breather to some of the race that we saw. We also saw a dollar gauge sliding to the lowest since 2008. Treasuries advancing and gold, as I said, climbing back above $2,000 an ounce. Now let's get straight on the latest on tech. The race to acquire TikTok is ramping up after President Trump signed an executive order on Friday forcing ByteDance to sell its U.S. business within 90 days. Well, Oracle is now said to be considering a bid for the video sharing app after approaching potential partners. Its entry could challenge Microsoft's bargaining position. For more on all of this, let's get to Alex Webb, who's Bloomberg Opinion's European tech columnist. Alex, thank you so much for joining us. When you look at this race, is it Oracle and someone else and Microsoft, or is it just going to be the two?
So it seems as though Oracle, according to some of the reporting, has approached some other firms, most notably venture capital firms, about possibly doing a joint bid. Sequoia is a company that has been named as a huge venture capital company on the West Coast. Clearly, it is going to be an expensive acquisition. 20 to 50 billion is the number that has been mooted. But interestingly, of course, Oracle is sitting on quite a lot of cash of its own. It has a net cash. Well, no, I mean, it has cash at hand of something like 43 billion. So it might even be able to fund such a deal off its own balance sheet if it wanted to.
Alex, who does it more, make more friends to acquire?
Okay, we closed all our positions on Japanese yen. You'll see on the screen our profit.
With LinkedIn, and they have an advertising business through both LinkedIn and Bing, and this helps sort of build a new sort of beast in advertising. At the moment, the online ads are dominated by Google and Facebook, with Amazon taking an increasing share. Microsoft has a little bit around the edges, but nothing significant. So this would really create a sizable competitor in that space. It's hard to see quite how this fits strategically with what Oracle does, which is basically databasing and cloud software for the enterprise. And that might mean technically they're able to pull it out of the TikTok, pull TikTok out of ByteDance parent, but they would have to build a whole new leg to their business in order to monetize it.
Alex, talk to me about Apple and Fortnite. What's the latest on the case?
So we've had, Fortnite essentially engineer this situation, which meant that Apple was going to pull them from the store. Apple's really upped the ante now, saying that actually it might go so far as to terminate Epic's developer account. So at the moment, Epic can come up with updates to Fortnite if it wants and then submit them to Apple, only for Apple to reject them. What Apple's threatening to do is now not even to let them do that. So it's a real heightening of tensions, and I think it looks like it's unlikely that Apple's going to win out here, but it does raise big issues which will then be taken into account clearly when antitrust authorities, not least in Europe and the US, start looking or continue to look more carefully at the way that the App Store is managed by Apple.
Alex, as we look on to the rest of 2020, you talk about and write about tech every day. What do you think is the big question that they really want to know about? Is it, who gets into the White House? Because it's a difference if the Biden administration gets in. Are we talking about, possibly breaking up some of these giants, or is it something else?
I think that the election is significant, but primarily to see how relations with China develop, because there are so many implications of that Chinese relationship. You know, if you are cracking down on TikTok and on Huawei, does that mean that there are going to be more stringent retaliations from China on companies like Apple, who have a huge business in China? But equally, then there are implications for the hardware industry in the sense that the supply chain has been significantly disrupted by crackdowns on what sort of semiconductor material and machinery you're able to sell to Chinese companies, in particular Huawei. So the clarity from the election, at the very least, will be really important, and determining to what extent a Biden administration, if Joe Biden were to win, whether there would be a softening of the position towards China. So I think China is at the forefront of everyone's minds. The investigations into big tech and the possibility of a breakup, I think they're probably going to carry on no matter what. I think the reality is that when you have a split House and Senate, it's hard to arrive at a conclusion which will, push through any significant change in the near term.
Alex, thank you so much. Alex Webb there, Bloomberg Opinion's European tech columnist. And now coming up, we'll talk about tech. We'll also talk about the world's biggest miner speeding up its plans to exit coal. Our interview with the BHP Chief Executive Mike Henry is coming up later in the program. This is Bloomberg.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, what we'll do is actually have a look at the market straight away, because there's quite a lot going on in the markets, especially for a quiet, or meant to be quiet, August day. Now, this is what the European stocks are focusing on. First of all, they're falling with U.S. equities, U.S. equity futures. This is on the back of what President Trump has been doing and saying, and actually it's because his administration has been stoking tensions with Beijing by announcing new restrictions on Huawei technology. Now, that's giving a little bit of angst in the markets. $8 a gauge sliding to the lowest since 2008. I'm also looking at, for example, treasuries advancing, gold climbing back to $2,000 an ounce, and iron ore futures rallying to the highest since 2014. Now, Carnival Chief Executive Arnold Donald speaks exclusively with Bloomberg's Carol Massar on the state of the cruise industry and COVID-19 in the U.S. Well, he says cruises could resume this year, but it's too early to make a determination with public health restrictions still in place. Here he is.
Right now, look at the U.S. In many places, we're still talking about sheltering in place, stay at home, very limited. Universities are figuring out what to do. Schools are figuring out what to do. And as long as we're not, just comfortably socially gathering, then we shouldn't be talking about cruise. Now, you can comfortably socially gather with different protocols, physical distancing, wearing masks, et cetera. And at that point, when we're comfortably doing that in U.S. society, then we can seriously, take a look at cruise.
Arnold, one thing I want to ask you while we're talking about the CDC, I mean, the CDC, you guys have read everything that they have put out. They have put out a strongly worded order as they continue to do the no sail and push that off for ship sailing here out of the U.S. They say the current scientific evidence suggests that cruise ships pose a greater risk of COVID-19 transmission than other settings. And they talk specifically some of the research that, the Carnival Diamond Princess back in February, they talk about it transmitting COVID-19 at a reproduction rate that was roughly four times higher than what we saw at the epicenter of Wuhan. Do you agree with the CDC's assessment that cruise ships pose a greater risk of COVID-19 transmission than anywhere else?
I think what the industry will do is show the history that we have with other viruses, for example, norovirus and other viruses that happen, and show how, in fact, historically the industry has successfully mitigated the risk of spread on ships, lowered the risk relative even to shoreside type of activities. Now, we can't make that claim today for COVID-19, but obviously that's what we aspire to and what we're working on. And I think we'll show a body of evidence to the CDC, which I'm sure they are also accessing. As I mentioned, we're being informed by very capable scientists and medical professionals around the world to take a look at this. But let me assure you, as a company and as an industry, the cruise industry, nor us as a company, want to expose any guest to greater risk than they would have in similar activities shoreside. And so our focus is to make certain that, we are managing that risk at minimum, relative to what they would experience shoreside. And we aspire, of course, that when they cruise with us, they have less risk than the same experience shoreside. Now, when you talk about the Diamond Princess, I think people have to remember, number one, that happened really early on when there was very little understanding of COVID-19. Number two, that ship was a quarantine ship. The ship was in quarantine for 2 weeks. It was not just a normal cruise, okay? It was a quarantine ship. And so while it's an example of something that can happen, I think the practices today would be dramatically different than what existed at the time of the Diamond Princess, and was different than what happened on subsequent cruise sailings.
Do you think if that happened today, you would have shut down immediately in terms of all operations? No new ships would go out? Because I do wonder, when you look back at February and March, what did you learn? What regrets that you have that maybe do you wish you had shut down ships, right after the news of some of the virus cases on Diamond Princess?
Carol, it's not any analogy or breakdown if you push it too far, but should the world have shut down immediately once Wuhan province had a situation, with COVID-19? I think you can only operate in the time you're in with the information you have. Back when Diamond Princess first started, there was not community spread around the world on COVID-19. There was very limited understanding of it. And even at the time of the sailing of Diamond Princess, there was very little understanding, about COVID-19. Even now, we're still learning every day, about this virus. And so it's not to make an excuse, it's just simply to point out that at that point in time, we did what we always do and what we will continue to do. We complied.
Well, that was Arnold Donald, the chief executive of Carnival, speaking to Bloomberg. In the meantime, European equities are trading a touch weaker this morning amid a U.S. stimulus stalemate and tensions between Washington and Beijing. That's after the S&P 500 failed at another attempt to break its record high. The Nasdaq, meanwhile, outperforming as Amazon and Alphabet extended their rallies. Well, joining us this morning is Karen Ward, chief market strategist for EMEA at JP Morgan Asset Management. Karen, as always, great to speak to you. So thank you so much for coming on. What exactly is the market focused in right now? I mean, I'm struggling to understand what's priced in. If a second wave is priced in, if a second term for President Trump is priced in.
It's always the toughest thing, Francine, working out what is priced in and therefore what's going to come as a surprise. My assessment is what is priced in is an ongoing recovery, one that is relatively constrained. I think the evidence from around the world and increasingly here in Europe is getting back to full normality is not going to happen until we have a vaccine in place. But nevertheless, that's affecting parts of the economy which are not necessarily represented in the equity markets. I think that distinction between GDP and the stock market is very critical to understand some of those indices you've mentioned, the Nasdaq, the S&P, for example. It's tech, it's the real winners from the COVID-19 recession that are keeping those markets elevated. So I would say what is priced is an ongoing recovery that's slow and very firmly supported by policy. So central banks keeping interest rates on hold for a significant period of time. Long-term bond yields tell you how low those interest rates are going to be to support that recovery. And also that policymakers within the government spectrum are also going to keep doing incrementally, adding to stimulus. So we've already heard Germany extending the furlough scheme. The UK Chancellor is clearly under pressure. And I think a bill or some support package from Washington is also priced. So I think in terms of disappointment, it would really be that, policymakers are not delivering on that stimulus. That was what would concern me about another leg down. But I think that's not our core scenario right now.
Karen, when do we start worrying about inflation? Is it something that we postpone to, 2021 or even 2022?
It's a great question, Francine. I think it's probably the question that's most prominently filling up my inbox from clients at the moment. I'm slightly more concerned about inflation proving a little bit sticky, not running away, not running up to 4 or 5%. But I think this was a recession which affected the supply side of the economy and the demand side. I'm sure many of you who've had your first haircut experienced that price being higher. Many businesses are very much reduced in terms of their supply, but they've got the same fixed costs. So they're having to increase their prices in order to, keep their revenues afloat and match their costs. And I think we've already started to see that supply side effect come through in some of the data. We had an upside surprise on US inflation. There have been some others around the world. So I think we do just need to keep a bit of an eye on that in the short term. As we look to the longer term, I think the question really is whether policymakers, this extraordinary effort we've seen from the central banks combined with governments, whether those taps are turned off in a timely manner. And again, I think there are some potentially upside risks to inflation over the longer term from that. I think the central banks are going to be under tremendous pressure to help governments with these high levels of debt by keeping interest rates low. And if governments don't turn back towards austerity, and I suspect they won't, then again, if central banks and governments are working in a combined fashion with their foot on the pedal, that's what gives us some longer term inflationary risks. So as I say, not expecting it to run away, but I think given the pricing of inflation protection at the moment, it's worth just having some insurance in a portfolio.
So, Karen, if there is a bit of runaway inflation, where do you see it first? And what does protection against inflation look like? Do you just buy gold?
Again, great questions. I think it could be broad-based. I think the good side, it comes back to those supply side disruptions. The goods supply chains on the goods side have been disrupted, not only through domestic production, but ability to transport those products internationally. And then the service sector, again, it's the capacity constraints, restaurants only being able to operate at half capacity, hairdressers, all these other service industries. So it could be broad-based. And then again, thinking about the longer term, if it is that central banks and governments are basically working together, then that again could lead to broad-based inflation. So I'm not sure it will show up in one particular place. With regards to inflation protection, I think the outside of the UK, where we clearly have some things going on with the potential transition from RPI to CPI, but I think the linker markets, okay, that since I started talking about inflation protection, it's not as cheap as it was, but I think there's still opportunity there on the longer term pricing for the index linked markets. And then I think it's a question of looking at real assets. I think increasingly as we look at how we build a robust portfolio, increasingly looking to alternatives, looking to core infrastructure, looking to core real estate, where that also should serve to provide some inflation protection. And moderate inflation would be okay for the stock market as well. I think it's if inflation is in the sort of 3% region, that's the sweet spot actually for stocks. So I think that's also worth bearing in mind. And I don't see it accelerating much beyond 5 to the point where it would really worry the stock market.
Karen, thank you so much. Karen Warren, their Chief Market Strategist for EMEA and JP Morgan Asset Management, stays with us. Now, coming up, Brexit is back. Talks resume in Brussels, but with just 7 weeks to go until negotiations are set to end. Who will blink first? We'll discuss Brexit and UK assets next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Brexit talks resume in Brussels today. Just 7 weeks remain until negotiations are scheduled to finish on October 2nd. But neither the EU nor the UK is yet to budge, with officials in both camps saying they're waiting for the other side to blink first. Well, still with us is Karen Ward from JP Morgan Asset Management. Karen, we have questions about Brexit, we have questions about negative rates, and simply how the Bank of England is actually modelling the recession and the recovery. Where do you see value in UK assets?
Well, I think, again, with that negative interest rates being left on the table, then within the UK stock market, for example, the financials are still going to probably suffer while that still lingers. Energy is another big component of the FTSE. We know it seems until we're into full recovery, energy prices seem capped at around the $40 mark, certainly how the market's behaving. So I think that's going to continue to be an issue. Then I think it's really a question of sterling for the broader international large caps. I think the market is pricing a deal, and therefore that's supported it. So sterling has been somewhat supported as the dollar's been falling. If that turns out not to be the case, then I would expect sterling to fall, and that could help the large caps.
Thank you so much, Karen Ward, their Chief Market Strategist for EMEA at JP Morgan Asset Management. Now, coming up, Joe Biden readies for his keynote speech to the Democratic National...
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a taxi.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, U.S. futures drift after the S&P 500 fails at another attempt to break a record high. This comes as chances for a deal in Congress on a new comprehensive stimulus package before September diminish with each passing day. Democrats and Republicans are focused on their presidential nominating conventions. Well, this week is the turn of the Democrats.
To everyone who supported other candidates in the primary, and to those who may have voted for Donald Trump in the last election.
The failed federal government that watched New York get ambushed by their negligence and then watched New York suffer, but all through it learned absolutely nothing. So today, 6 months after it began, the nation is still unprepared.
Imagine if we had a national strategy. So everyone who needs a test gets one for free. So everyone has access to a safe vaccine.
More than 150,000 people have died, and our economy is in shambles because of a virus that this president downplayed for too long.
The truth is that even before Trump's negligent response to this pandemic, too many hardworking families have been caught on an economic treadmill.
Well, for more on all of this, let's get straight to Jody Schneider, Bloomberg Senior International Editor, who joins us. Jody, first of all, was this the most important speech of the first night of the Democratic National Convention?
Well, there's two clips you just showed. Those were the people who were the most important that on that first night. What Joe Biden has to do is energize and unite the party. And Michelle Obama and Bernie Sanders were the ones to do that for him, and they both gave speeches that really sought to do that. Bernie Sanders, in his speech, was unequivocal. He almost begged people, progressives, to vote for Biden. And, of course, 4 years ago, he didn't. 4 years ago, he did not back Hillary Clinton in the same way, and it cost the party. But his speech last night was all about, he basically said to everyone who supported other candidates, you need to get behind Joe Biden. You need to defeat Donald Trump. And Michelle Obama's speech was powerful because, first of all, she doesn't usually give that political of a speech. She supported her husband for 8 years. She gave speeches, obviously, in support of him when he was in the White House, but she wasn't usually this overtly political. And she came right out and said it. She came right out and said what the party wanted her to say, that President Trump is in over his head, and he's the wrong president for the country at this time. She talked some about Joe Biden and how she knew Joe Biden and the kind of man he was, but she basically was very, very critical and on the issues of the sitting president, President Trump, and on the issues that the party wanted her to be critical on, particularly the coronavirus pandemic. This was the Democrats' first night. It was an important night to come out swinging, if you will, and they'll have a few more chances to do that in coming days, and then it's the Republicans' turn.
I was going to ask Jody, it feels like the first night was just about unity, right? Showing that the Democrats have a united front, that they stand together, and they support Joe Biden. What are we going to get for the rest of the week? What messages are they working on?
Yeah. I think that message is going to continue for this week. They want to present this unified message. They don't want, as I indicated before, problems like they had 4 years ago when there were people who weren't going to vote for Hillary Clinton. They weren't going to vote for Donald Trump, but they weren't going to vote for Hillary Clinton. They don't want that again this year. They want the party united, and they need turnout, and it's going to be a complicated year for turnout because of the virus and because of the disrupted voting. People are going to have to vote in all different kinds of ways. So they want to come out of this convention getting people energized and getting them to want to vote, no matter how they go out and do that in November. They also want to present an image of not only unity, but of they want to take on this president directly and on a number of issues. And that's what we're going to see over coming days in all these speeches.
Jody, what's the latest on the wrangling between Democrats and Republicans on the stimulus bill? Are we going to have some kind of agreement? And if we don't, I mean, people need the money. They don't have the funding that they had. Who are they going to blame, the Republicans or the Democrats?
Yeah, that's a good
question. Right now, it looks like they might blame both sides because they are not getting any closer, as you indicate. Senate Republicans say they plan to introduce a scaled-back stimulus bill among the standoff that's dragged on for weeks, but that could take a long time. There's no immediate signs that Senate Majority Leader Mitch McConnell is going to call senators back from their August break to vote on it, and any legislation would need at least some Democratic support. What we're hearing from people familiar with the plan is that legislation would include $300 a week enhanced unemployment benefit and things like money for small business aid. That proposal would be about $1 trillion. Some Republicans think that's too much, but it's much less than the $3.5 trillion plan that Democrats passed in the House in May. So there's still a long way to come together. And as you indicate, people have not had their unemployment benefits now and are not getting them. And this will become an issue. And with just 78 days until the general election, there certainly will be a lot of blame. And some of it will come toward Republicans, although Democrats, if they hold out for more money, will likely get some of the blame as well.
All right, Jody, thanks so much. Jody Schneider there, Bloomberg Senior International Editor. Now, the U.S. has announced further restrictions on Huawei aimed at cutting the Chinese company's access to commercially available chips. It's the latest move in an increasingly tense relationship between the world's two biggest economies. Well, Light Street Capital Management hold names like Alibaba and Tencent, and its founder and president spoke to us about why ongoing U.S.-China tensions won't affect their quality.
Amazon's an amazing company, and I think really if we have 0 FANGs in our top 10 right now in our hedge fund. We have a long-only fund where Amazon is in the bottom half of the top 10. We've been able to outperform on the long side of our book, not being overly exposed to the FANGs. That said, I don't think it's a bad place to invest. I think your general equity investor, consumer, if they could do a lot worse than having big exposure to FANG stocks. These are some of the best performing companies and businesses in the world. And so we're not afraid to have a little FANG exposure. Specifically on Amazon, they have obviously the #1 e-commerce business in the world, quite dominant in the U.S., in continental Europe, as well as other international markets like India and the Middle East. And that e-com business is worth about half of the company's value. The other half has been built up on the cloud computing business with AWS, and we continue to see them being one of the giant leaders in that business. And the fundamentals there, it's growing 30%, margins are higher than 30%, or at least very close to 30%. They bounce around depending on the quarter. And, we think that's going to continue to be a great leader. So that's why it's one of our largest holdings.
Well, Glenn, a lot of your peers also sold out. We saw through the 13F filings on Friday, a lot of the Tiger Cubs getting out of Netflix, Amazon, Facebook. Why do you think so much of the industry is starting to sour a little bit on some of these big names? Is it a matter of valuation?
It's probably a rebalancing, in terms of looking for companies whose valuations are more stretched and reducing some of those holdings. We've certainly done that in some of our big winners. And then you rotate into companies that, look especially attractive. And so it's a normal course of investing, being a portfolio manager.
Glenn, a lot of your portfolio, more than 40%, is outside of the U.S. Some of that is in China or with Chinese companies. What is your feeling about investing in Chinese firms amid all these tensions between the U.S. and China?
Yeah. Well, I think there's been tension, really increasing tension for the last 10 to 20 years. And there is tension specifically around Chinese companies that list in the U.S. What we're seeing happen is that many Chinese internet firms are now dual listing and having an IPO on the Hong Kong market, and that gives them optionality perhaps to in the future perhaps they'll only be listed in Hong Kong. And I think these are such incredible businesses. We're long Alibaba, we're long JD, for instance. We're long Tencent. These are great, incredible companies that have real, dominant presence in social media, in e-commerce, in payments. And I don't think that a row between the U.S. and China is really going to change the quality of those businesses in the long term. They have little to no exposure to our end markets here, and we're quite bullish on them.
Well, that was Light Street Capital Management founder and president Glenn Catcher. Now, coming up, BHP shares slip in London trade as the world's biggest miner speeds up its plans to exit coal. Our interview with the chief executive, Mike Henry, is up next. This is Bloomberg. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, there's a lot to talk about technology, but also mining stocks. Let's get the latest on the world's biggest mining company. BHP says it's to broaden plans to exit coal operations. That's as management reshapes the company's portfolio for low emissions future. Well, we spoke to the chief executive, Mike Henry.
The recovery continues to be underway and appears strong in China. I think we're going to see quite a bit of volatility and uncertainty in the way the rest of the world recovers. And our broader economic forecast is for it to take about a year for the world to get back to pre-COVID levels of economic activity, and 2 or 3 years to get back onto the trajectory that we otherwise would have been on. But that's the broad economic outlook. In terms of iron ore itself, demand remains strong in China. Blast furnace utilization rates are quite high, and that appears to be holding up quite well. Of course, on the supply side, we'll see more supply coming to market from our competitors as they get past some of their challenges. But our strategy of being the lowest cost supplier, continuing to improve quality, and delivering continuous improvement reliably year in and year out, that holds. That's the winning strategy.
Do you expect iron ore prices to average $100 a ton next year?
I wouldn't want to give an exact prediction. I do think as more supply comes to market, we could see a bit of retracement in iron ore prices. But BHP is a diversified resources company, and we've got other commodities in the portfolio that as the rest of the world recovers, we do expect that will result in perhaps more favorable market dynamics. So the resilience of the portfolio that we have, which has helped us see through the last 6 months of COVID, is going to stand us in good stead going forward as well, in spite of all the uncertainty uncertainty out there, the resilience of our portfolio, the resilience of our people will allow us to continue to perform strongly.
You know, you're looking to make an exit from coal, but BHP is not alone in this. How confident are you that you'll have enough buyers, that you'll get the right price, or is there investor appetite for a spin-off entity?
I want to be very clear here. This is an exit from 4 of our coal operations. We continue to see great value and upside in our higher quality hard coking coals, which will, you know, as steel makers move to reduce their carbon footprint and they lift blast furnace utilization as one means of doing that, there's going to be more demand and more upside for higher quality hard coking coals. So we remain committed to that core of our portfolio. We have other assets whose value will be realized through things like major capital investment and which are unlikely to compete well for capital within BHP, given our broader portfolio intent and the other options that we have available to us. Now, as to how we go about doing that, we're open to all options. And one of the reasons why we've come forward early on this is to give us the ability to get out there and explore different options, either trade sale or demerger, for example, being 2 of those options. We'll land the right solution in the next year or 2, and that solution will be the one that maximizes value for shareholders.
Mike, you've also flagged plans to sell a share of some oil and gas assets in Australia. What's the longer-term plan for BHP in oil?
We see oil as being attractive, and that's on the basis of both ongoing demand for oil, given its underpinning to human mobility and many of the industrial processes that underpin better standards of living, coupled with, on the supply side, ongoing decline curves, which are a feature of the industry and conservatively 3% per annum. So there's going to be more oil supply that's needed. We think there's great value and returns to be generated in oil for the foreseeable future, so certainly the next decade, likely beyond that. So we'll continue to invest in oil and growing value and returns.
Well, that was Mike Henry, the chief executive of BHP Group, speaking to us a bit earlier. Now let's dig deeper into the sector with Grant Spohr from Bloomberg Intelligence. Grant, thank you so much for joining us. There's a lot to talk about when it comes to mining stocks. What have been the main challenges right now to the mining sector? I mean, you know, we're in lockdown, or we have been in lockdown, so the world economy is just going down. But is there anything else that we should be looking at?
Good morning, Francine. Thank you for having me on. Yes, it has been a challenging period for the mining stocks, but I think they've actually weathered the storm very, very well. So from an operational perspective, they've implemented a lot of social distancing, but I think despite having to cut workforces down to sometimes 30 to 40% of pre-COVID levels, production has hardly dropped. Now, it's fair to say BHP has said, you know, next year copper might be down slightly. I think they've said about 5% because we can't staff our operations quite fully, but in the big scheme of things, that's a fairly minor impact. They've also adopted technologies very well. So in terms of, for instance, having technical experts view some of their projects remotely via cameras has been very successful, and remote operations center, being able to control remotely. And on the flip side, of course, China's surge of liquidity and credit has helped the demand side, and particularly when we look at steel production, it's up 3% year on year after a very strong 2019, and that's led through to very strong iron ore demand and the prices that we see today. So all in all, the sector is actually, all things considered, in fairly good health.
What can we actually expect from dividends? How much of the focus from chief executives will be, you know, to make sure that investors are loyal by just dishing out?
Well, I'd say, you know, in the very, very short term, so if we look at BHP's result in terms of dividends, it's probably disappointed slightly. I think, you know, consensus expectations were for slightly higher than the $1.20. But if we take a broader view, I think that the ability to pay dividends from the miners is still very much intact. So most of them, and BHP as an example, is right at the bottom end of their net debt range that they feel comfortable with. And given the strong cash flows, particularly from iron ore, which could continue in the second half, the outlook for dividends look pretty robust. There is a slight air of caution, and that's maybe why BHP held back a little bit in paying perhaps higher dividends today is there is the uncertainty of how COVID plays out in the future. And maybe that's what led the company to just hold back a little bit. So we are seeing an air of conservatism in terms of dividends. But overall, dividend yields still look pretty healthy.
Grant, what does China actually tell us about the recovery for the mining sector?
So China, as I mentioned earlier, I mean, the credit growth this year has been very, very strong. So it's up on a total social financing basis, it's up 40% year to date. And of course, any stimulus in China tends to be quite commodity intensive. And the government tends to pull the lever of either infrastructure or property, which looks to be very, very healthy. And that spills over particularly into steel demand.
Yeah.
So I think for those miners that have iron ore exposure, that's certainly a decent outlook. And although copper isn't quite as exposed to the infrastructure property cycle, it still has a good read across. So even the copper demand looks as though it's been picking up quite well.
Grant, thank you so much for the great insight. Grant Spohr there from Bloomberg Intelligence. Now, coming up, we'll have plenty more on Elon Musk. Keep on climbing. That's what Elon Musk is doing to the list of the world's richest people. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, Elon Musk is now the world's fourth richest person. Tesla shares surging some 11% on Monday, boosting Musk's net worth by $8 billion in just one day. Well, joining us now with more details is Danny Berger. Danny, I mean, $8 billion one day, not bad.
Yeah, not bad at all, Francine. I mean, these numbers are so difficult to wrap your head around. Not just today, year to date, his net worth has more than tripled, gaining $57 billion this year. And look, a lot of that, if not most of it, is coming from the gain in Tesla's share price, surging 340% this year. And Musk himself owns about 20% of the company, so he's really benefited from the enthusiasm around the stock, be it because there's thoughts it might be included into the S&P 500 index, be it retail traders who really love Tesla. Some of Musk's wealth has also come from Tesla options, where you can see there more than $13 billion, and that's because a lot of his compensation package is tied to the market value of Tesla. So once that hits certain milestones, he gets more in terms of Tesla options. Now, SpaceX also about to close another funding round. That valuation put at $46 billion. So he has all these different sources that are contributing to this huge surge that we've seen in Musk's wealth, Francine.
Danny, could his sudden surge in wealth also put Elon Musk and Tesla under more scrutiny?
Well, I mean, he's the fourth richest person. The optics certainly aren't good during the coronavirus. So in that way, it certainly could. But you look at who his company is. The other top the richest people in the world include Jeff Bezos. That tech CEO, besides, had the biggest gain in net wealth. Musk is number 2 so far this year. And Bezos had to testify about Congress, saying, I don't have too much power, but his wealth certainly says something different. Tesla, for its part, becoming a huge company, now surpassing PG&E in market valuation, Francine.
Thank you so much, our Danny Berger there with the very latest on Tesla and Elon Musk. Now, Bloomberg surveillance continues in the next hour. Tom Keene joins me out of New York. We'll be talking markets. We'll be talking about the DNC. We'll be talking politics in the U.S. Of course, we'll talk about these U.S.-China trade tensions. Now, it's very clear that European stocks are not taking in their stride the fact that there seems to be a bit more aggravation from the U.S. side, certainly when it comes to Huawei. We'll also look at technology with that news about TikTok. I think we'll be speaking to our Alex Webb throughout the 2 hours. This is Bloomberg.
Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
Deadlock in Congress. Senate Republicans plan a slimmed-down stimulus bill, but Democratic support looks unlikely. Competition for Microsoft. Larry Ellison's Oracle is said to be interested in buying TikTok's business in the U.S., while others join the contest. And the world's top miner, BHP, reports steady underlying earnings on a surge in iron ore, while the chief executive, Mike Henry, speeds up plans to exit coal. Good morning, everyone. This is Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, it's another busy day, actually, in August. Again, volumes are quite thin, but I think a lot of the focus is on these aggravated tensions between the U.S. and China, certainly on Huawei, after the latest from the Trump administration. Of course, we talk about the Democrats and the DNC.
It's the oddest August, Francine. It's summer and it's not. And, of course, all of you are wondering why Francine is at home. If you follow her on Instagram, you will know it's a surveillance veterinary clinic, and they have a bird in the backyard, and they've been taking care of the birds. So Francine had to stay at home to save the birds of London. That's a good thing to see. But it's the strangest August, Francine, and really, to me, the only litmus paper you've got right now is a weaker dollar is sort of the preponderant trend this morning.
Yeah, weaker dollar. I'm also looking at a couple of things. You know, when it looks at iron ore, it's actually significantly up, and we're also looking at gold. So it'll be interesting when we do our data checks. But first, Tom, let's get straight to the Bloomberg. First word news in New York City. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine, Tom. Michelle Obama described President Trump as unfit for office on the opening night of the Democratic Convention. The former First Lady blasted him for mishandling the pandemic.
More than 150,000 people have died, and our economy is in shambles because of a virus that this president downplayed for too long.
Obama said that Trump is clearly in over his head. President Trump added a trip to Iowa to his schedule today. His support has been slipping in a state he won by 9 percentage points in 2016. Polls now indicate Iowa is up for grabs in the race with Joe Biden. U.S. officials are playing damage control after trade talks with China were indefinitely delayed. President Trump told Fox News that he's having a very hard time with China, but the country is trying to make up for it with purchases of American farm products. White House trade advisor Peter Navarro says the trade deal is still on track. In Canada, Finance Minister Bill Morneau has resigned after a rift with Prime Minister Justin Trudeau proved impossible to repair. That leaves Trudeau with a major hole in his cabinet in the midst of a recession. Bloomberg's learned Morneau's replacement will not be former Bank of England Governor Mark Carney. Carney has been advising Trudeau on an economic recovery plan. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Equities, bonds, currencies, commodities. Let's look at it right now. As I mentioned, weak dollar is the major theme today. I thought Kit Jukes of SocGen with a really smart morning note looking at where inflation break-evens are and the dynamics that brings to the dollar market. What we've got all in all is futures up fractionally, just a churn there. Yields are lower. Yields have come in nicely, 3, even 4 days in a row. More than anything, I'm looking at that 10-year tips negative 0.99. So that's a greater negative number, a much lower, more negative real yield over the last. I'm only quoting that because I missed John Farrow. Sterling 131.75 as well. Turkish lira not part of the story, at least yet today. Francine?
What, you're not planning to come and visit me in London anytime soon, Tom? I thought that's why you were looking at sterling. European stocks struggling for traction. U.S. equity futures also kind of struggling for traction. There is a sense, Tom, that first, you know, the Trump administration definitely stoked tensions with Beijing by announcing new restrictions on Huawei technology, which is why maybe we're also seeing a lift to gold, climbing back to around $2,000 an ounce. Treasuries advancing, and also iron ore. I'm going to add that to my data check because I don't think I put it in, but I wanted to. Iron ore futures actually rallying to the highest since 2014. So to talk about the economy and to talk about markets now is Banu Baweja, UBS Investment Bank Chief Strategist. Banu, as always, thank you so much for coming in. What's priced in the markets right now? Are they too optimistic about a possible second wave of COVID, or are they also ignoring, you know, the possibility of a Biden administration in the White House very soon?
So the markets have been optimistic for some time. So if we can actually back this out mathematically, what the markets are pricing in terms of global growth, Francine, is global growth around 4%. And just to put that in context, long been somewhere close to 3.5. So you're almost one standard deviation higher than the long-term average of global growth. That's what the markets are pricing in right now. But of course, that's been driven by liquidity, and that's been driven by the amount of help that the Fed has given this market. It's been driven by, as you folks were discussing earlier, lower real interest rates. So the key question for the market is, can real interest rates continue to drop? Can break-evens continue to rise? And I think that's where we're coming to limits of how far inflation expectations can rise.
But I was going to ask you, if there's one thing that you need to get right, is it if inflation rises, and if there's even a chance of that, do you buy gold?
Look, I think you buy gold for different reasons. So the answer to that is yes, you buy gold if inflation rises. But I personally put the probability of inflation rising at a very, very low level. You can't get significant inflation if the labor market is in the doldrums, right? If you look at where the furlough schemes in Europe are, and at one point they're going to not be rolled over, perhaps towards the end of this year, perhaps early next year. 49% of France is on furlough. The unemployment rate in the US is going to remain quite high, perhaps in the teens, even in 3 to 6 months' time. And that's a situation in which there's going to be tremendous pressure on wages. Now, other than the 1970s, the supply shock of the 1970s, there hasn't been another time where you've had inflation without wages going up. It took 10 years of running monetary policy really hard to get the low-skilled wages going up in the U.S. labor market. So without that, I think the kind of numbers that we saw in the U.S. last week are an aberration. The market is pushing up break-evens, and the break-evens have been responsible for nearly 100% of the move lower in real interest rates, and that's fed into the US dollar. So we have to be quite careful on how much we extrapolate that. I think that move is coming to maturity.
Bono, I'm so glad you brought that up. Tom Keene in New York, and good morning to you. I was just looking at the 5-year break-evens across the 3 major parties, and it is really extraordinary to see what has not occurred here. We really haven't seen higher inflation expectations. Bono, I think from a strategic standpoint and into the autumn, and frankly, maybe beginning to view into 2021, there are these glimmers of hope, but against it is a wall of tough data, the things like the Boeing layoffs, the Marks and Spencer news this morning. Has the market priced in a non-V-shaped recovery?
No, the market has priced in a V. The market has priced in normalization. The market is treating this as a complete income statement shock. They don't think this is going to have solvency impacts. They don't think this is going to have balance sheet impacts. And so the market has priced in a complete V. From here on, I think what is important is last week, for instance, it was quite remarkable. You said it was a very strange August. Last week, the markets held up reasonably well, despite the fact that you didn't have any agreement between the Democrats and the Republicans in the package. Why did the market hold up? Because there is vaccine hope. Now, that vaccine hope, I think, is quite important in keeping the market going right now, but that's 1 to 3 months. I think beyond that, the reality of growth and liquidity will have to be reassessed by the market.
This is so important, folks. And Stephen Roach scheduled to be with us from Yale University here, and he's always talking about the balance sheet dynamics versus the income sheet dynamics and analysis that maybe is preponderant, particularly in the United States. How will the central banks react to this? I mean, what is the next step for central banks looking at a non-V-shaped recovery? What more can they do?
And this is the key point, not much, because they've already brought down rates quite a long way. In the last 3 months, break-evens have done the job of taking real interest rates lower. The Fed can move towards average inflation targeting. The Fed can talk about YCC. But YCC, if they're going to do it to about 3 to 5 years with yield curve control, that is, they have spoken about in their previous minutes how they consider sort of the RBA as the model for that, which is 0 to 3 years, is completely priced in. So they cannot surprise on the upside on there. So the only question is, if they say we're going to target average inflation at X, and X is a much higher level than 2%, is that going to be credible? They've really struggled to hit core PCE above 2% for any length of time in the last 15 years. And I personally think that it's going to be difficult for them to push inflation expectations much higher. And that's why, and mind you, this is not just the US. Look at Japan. Look at Europe. These folks have not been able to take down their real interest rates, unlike the US, because their inflation expectations have not picked up. Draghi spoke about plus 2% in terms of inflation, which basically means core inflation going to 2%. We're a million miles from that.
All right, Banu, thanks so much. Banu Baweja there of UBS Investment Bank. He stays with us. Now, coming up on Balance of Power, Ralph Schlosstein. He's the Evercore co-chief executive. That's in an interview at 12 p.m. New York time. That's 5 p.m. in London. And this is Bloomberg.
We are above forecasts. 1,800,000 jobs is the total non-farm payrolls, with 17,000 additional jobs added in terms of net revision.
You still got 1.8 million with a big decline, almost a full percentage point drop in the unemployment rate, which will move to single digits easily in the summer and fall.
Leading up to this data, there was a lot of reason to suggest that the pace of increase had slowed. And in fact, what we see in this data is, of course, it has slowed. But the good news is that it is continuing. And it is continuing despite some slowdowns that we're seeing around the country as a result of an increase in cases.
People tend to focus on the growth rate. The big issue is the depressed level of spending and income in the economy, which is reflected in the level of the unemployment rate of around 10%.
Some things you see coming, some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
Good morning, everyone. Bloomberg Surveillance from London, from New York. Francine Lacroix and Tom Keene. A good conversation now with Banu Baweja of UBS. We've been talking about some really important, really delicate themes, and one of them is the idea of reflating our way through this pandemic. The phrase that seems to be in the zeitgeist is to get to the other side of the bridge. Banu, where's the bridge end? I mean, the biggest problem for me is it seems to be time determinant on discovering a vaccine. That becomes more apparent every day. Do you just assume the goal here is to get through 2020 and somehow get to 2021 and a vaccine?
Tom, there are much bigger questions than that. I think first on the vaccine itself, I suspect the market is going to treat it as a digital event, 0 or 1, but it's not going to be a digital event eventually, because the market's going to think normalization is going to buy the laggards as soon as you get the vaccine. But of course, whether the vaccine will be mass produced, to how many people will it be available in the US, how many people will actually take the vaccine. So the key question is whether mobility will improve to 100% once the vaccine is here, and I think the answer most epidemiologists will say is no. So I think in terms of the economic data recovery, it's still going to be quite slow. For Europe, for instance, we still think that in 2021, by the end of 2021, we'll still be below sort of the high water mark that 2019 was. That's just the vaccine question. Mind you, the markets will react differently. The bigger question is policy. there inevitably will be an air pocket in the coming quarters and years. And how much can policy help when real interest rates are already at negative 95 basis points? How much can policy help in the future? China, how much can China help if debt to GDP is already through 300%? Policy has used important ammo through this crisis, and they have much less left, both on fiscal and on monetary, into the future. I think the market believes that fiscal expenditure can continue unabated. Central banks can continue to buy, and that will mean inflation expectations go higher. I really think the reality is quite different from that. So policy running out of juice, I think, is a major theme for valuations for markets into the coming years.
What is the strategic opportunity? I mean, as a chief strategist for a major Swiss bank, I mean, the idea here is you have to have somewhere back on page 13 the opportunistic plan. What is it?
I think the key question is how we get income and how we get diversification for our clients. And it's going to mean that past valuation models are not going to hold good for the future. We were speaking about gold earlier. I don't think this is a major inflation hedge, but I think gold is one asset class which already is breaking models, and I think will continue to break models. So compared to real yields, the elasticity of gold, for instance, is going to be completely different. I think gold is going to do much better. So the question is going to be, in the equity side, whether you see a shift towards value. Is that a major strategic opportunity? Emerging markets, is that a strategic opportunity? And we believe the answer in both cases is no. These are tactical opportunities ahead of the U.S. election, ahead of a possible vaccine for this virus. You rotate away from the U.S., you rotate away from growth towards value, but this is a 1 to 3 month trade. The strategic opportunity still exists in the United States. It still exists in quality. It still exists in minimum wall. That's where clients will go to look for income. That's where clients will go to look for capital appreciation. You will get moves into emerging markets for income in terms of credit and in terms of fixed income, but I'm afraid not so much for equities. So gold, emerging markets credit, and quality and minimum volatility stocks. These would be a part of our strategic asset allocation portfolio.
When you talk about Banu, some of the value and actually some of the emerging markets, is there anything in emerging markets that could be an opportunity right now?
So emerging markets equities, Francina, are very different from emerging markets GDP because nearly 55% of that index is basically 3 countries, China, Korea, Taiwan. And of these, sort of the most value-driven is Korea, which I think gives you, and now I'm speaking from a tactical perspective, not from a strategic perspective, I think it gives you reasonable call optionality, both the equities and the currency in the near term. The big risk of that is that the trade war with China absolutely explodes with the U.S., and I think the probability of that, as we get closer and closer to the election, the probability of that is getting lower rather than higher, and it's clear that the U.S. administration doesn't want to engage in terms of the trade war. The broader geopolitical relationship with China is worsening, but they don't want to engage in terms of the trade war. So I think North Asia is where the opportunity is in the coming few weeks and months in terms of currencies and equities, and I would single out Korea. North Asia, and I would think about Korea as the one that may be the sort of disproportionate beneficiary.
Banu, if we have a Biden administration in the White House in the next couple of months, I mean, he'll start in January, if he does become president, what impact does that have on markets, and what exactly is being modeled at the moment? Does the market currently believe that Biden is the next president?
Yes, at the margin, the market certainly believes that. I mean, certainly if you look at the reaction to some of Trump's actions on China and how the market has disregarded that, I think that is evidence that the market has begun looking through this administration. Again, this is a question of probabilities, not zeros and ones, but if Biden was to come through, the big question is going to be whether there's a Democratic sweep or not. Already you're seeing levers move within the U.S. market as we move away a little bit from tech towards financials, towards industrials, towards cap goods. So there's a little bit of a move away from growth towards value. I think this would also be reflected, Francine, in terms of a move away from the U.S. towards the rest of the world. So I think the Biden trade in the equities market for the next 3 months is A, North Asia, B, Europe. not because Biden is going to be he's going to be much more lax in terms of the trading relationship, but the volatility, the risk premium around that trading relationship with China is going to go down. And certainly for Europe, the volatility of that trading relationship for Europe with the U.S. is going to go down. And as a result of that, I think this is a tactical opportunity to rotate away from the U.S. in the very near term. That doesn't hold, I don't think, for the longer term, because the U.S. economy just has much higher stimulus in its veins. And in 2021, you're going to see a significant decline, we hope, in the U.S. unemployment rate. And at that point, we want to be coming back. But here and now, ahead of the vaccine, ahead of the U.S. election, we think there is room for rotation, both factor rotation and also country rotation.
Banu, thanks for the brief. Banu Boesha with us with UBS, their chief strategist, is very informative there. I love the idea there of the analysis of the income statement versus balance sheet. I totally agree. The balance sheet dynamic is very important. A reason to speak to Stephen Roach, and we will do that later on surveillance. Coming up, it's been way too long on commodities, and yes, on oil at $45 a barrel. Mr. Chilangurian from BNP Paribas. Stay with us from London, from New York, with futures up 5. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
Investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Rishika Gupta. Let's get the Bloomberg Business Flash. The opening night of the Democratic Convention has wrapped. The event featured speakers including former First Lady Michelle Obama, Senator Bernie Sanders, and Republicans who have crossed the aisle to support Joe Biden.
I'm sure there are Republicans and independents who couldn't imagine crossing over to support a Democrat. They fear Joe may turn sharp left and leave them behind. I don't believe that, because I know the measure of the man. It's reasonable, faithful, respectful. And you know, no one pushes Joe around.
Boeing will make deeper job cuts than the 10% originally planned. The plane maker is preparing to offer buyouts to employees for a second time this year. Most of the offers will go to staffers in Boeing's commercial airplanes unit, services division, and corporate operation. The jetliner market has plummeted since the start of the pandemic. Now, Oracle is considering a bid for part of TikTok's business. Bloomberg has learned that the company has approached other parties to partner in an offer for the viral video streaming app, including venture capital firm Sequoia Capital. Microsoft has confirmed that it is in talks with TikTok owner ByteDance. And that's your Bloomberg Business Flash. Francine, Tom.
Thank you so much, Ritika. Now, this is what the markets are seemingly focusing on, certainly when it comes to Europe. Trading tensions between the U.S. and China actually taking a step higher, and that's having an impact on some of these European stocks. Now, European stocks are fluctuating. They were down. They seem to be moving sideways at the moment, but still, gold is on the rise, and then a bit of movement with dollar, Tom.
Very good. The VIX comes in, even with all the market. The NASDAQ doing better yesterday, Dow not working as well yesterday. The VIX 21.27 really has my attention, and the euro mark there, 119.07, shows a stronger euro. On the channel back 13 years, euro really buttressed up against resistance at a 119.07. Coming up on retail, Oliver Chen. This is Bloomberg. Good morning.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance. I'm Rishka Gupta. Let's get the Bloomberg First Word News. Bernie Sanders all but begged his progressive followers to vote for Joe Biden last night. The former presidential candidate spoke on the opening night of the Democratic Convention.
But let us be clear. If Donald Trump is reelected, all the progress we have made will be in jeopardy. At its most basic, this election is about preserving our democracy.
Sanders acknowledged that Biden's healthcare plans fell short of his version, but he touted the proposal nonetheless. House Democrats will propose an extra $25 billion in funding for the beleaguered Postal Service. Bloomberg's learned it will be part of legislation that would prohibit cutbacks in service before the election. A vote is set for Saturday. Democrats want the post office strengthened before millions of election ballots are mailed. And in California, 10 million people avoided a blackout when temperatures fell. They may not be so lucky today. It's supposed to be 108 degrees in parts of the state. That could force rolling blackouts designed to save the power grid. It's the first time California has resorted to the blackout since 2001. And in Hong Kong, Chief Executive Carrie Lam says she's having trouble using her credit cards after U.S. sanctions were imposed. The Trump administration sanctioned Chinese officials and their allies in the city. That was in response to those sweeping new security measures that Beijing imposed. Lam calls the measures against her totally unjustified. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. We've been committed at Bloomberg Surveillance to having medical professionals speak to us about the virus. But every once in a while in this pandemic, you have to listen to the politicians speak about the virus. Here last night at the DNC.
To everyone who supported other candidates in the primary, and to those who may have voted for Donald Trump in the last election.
The failed federal government that watched New York get ambushed by their negligence and then watched New York suffer, but all through it learned absolutely nothing. So today, 6 months after it began, the nation is still unprepared.
Imagine if we had a national strategy. So everyone who needs a test gets one for free. So everyone has access to a safe vaccine.
More than 150,000 people have died, and our economy is in shambles because of a virus that this president downplayed for too long.
The truth is that even before Trump's negligent response to this pandemic, too many hardworking families have been caught on an economic treadmill.
The truth is, we go to the experts, and one of them that we've spoken to a few times is Pamela Vallely. She's at the University of Manchester in the United Kingdom, and she is esteemed in respiratory virology, also her important work on cervical medicine as well. Dr. Vallely, thank you so much for being with us. In the zeitgeist this morning is the great fear, and you're certainly qualified to address the fear. In New Zealand, the virus returns, maybe on a measured basis, but nevertheless returns. And at Chapel Hill, the University of North Carolina has made an abrupt shift because the virus just simply won't go away. I don't want to talk about a second or third wave, but is it delusional to believe you can get social again once you get control of cases and deaths?
Good morning. So I think it's vital in a way that we don't let ourselves be controlled by the fear of this virus. So certainly the virus is still with us. There's absolutely no doubt about that. We're seeing spikes of cases wherever lockdown is being relaxed. I think what we have to do is learn to live with the virus, so that we have to all learn how to take measures for ourselves, how to keep ourselves and each other safe. But I think the idea that we can live in lockdown forever, it just can't happen.
Do you see, this is a really important question, folks, and this, of course, deals with everyone with kids going back to school. Are we asking too much? Are we trying to find a medical perfection that doesn't exist?
I think there is something in that, yeah. I mean, certainly, so kids going back to school, we're definitely going to see some spikes, and the idea that young people don't get the virus is just not true. Young people certainly do get the virus, and they pass it on, and some of them, are get sick with it. We are not going to anytime soon get to the point where we can go back to what we all considered normal previously. So we have to, as I say, we have to learn to live with it.
But Pamela, what do we know and not know about the virus? So do we know if people that have had it are definitely protected? Do we know if you can fight it with T cells? And do we know if actually this thing is mutating or not?
So we know that people who get the virus do develop antibodies, and there is some work that does suggest that those antibodies are neutralizing. What we don't know is whether those antibodies actually do protect you from reinfection, and we don't know how long they're going to last. Coronavirus's antibody response generally doesn't last very long, maybe a year in most people. The T cell response certainly does seem to be important, and many of the vaccine strategies that are coming into trials at the moment are also considering making sure that the T cell response works as well. The virus, we're certainly tracking the mutations. There's a lot of good work being done in the United Kingdom and elsewhere to look at how the virus is changing, and certainly that we have seen mutations from it originating in China and moving across Southeast Asia and into Europe, and the virus has mutated in that time. Now, we don't know what that mutation particularly means. There were some suggestions at the beginning that the mutation, as it got to Europe, made it more virulent. But I don't think that has been proven. It seems to make it more transmissible, so it can pass from person to person more easily. But whether it makes it a more severe infection, it isn't proven at all. And the usual way with viruses is that as they mutate, they become less severe, so they sort of attenuate. So we just we need to track it. We need to monitor it very carefully.
On the antibodies, if it's unclear whether you're protected once you have antibodies, does it mean that we could also potentially never have a vaccine?
I think the elements of the T cell part of the vaccine as well. Potentially, it could mean if there's no immunity to this virus, then a vaccine wouldn't work. But I think that's very unlikely to happen. And I think worst case scenario is that a vaccine may not be fully protected, but it may make for a less severe disease. That's it's not an ideal thing with a vaccine, but it would be better than the situation we have at the moment. So I think that the likelihood is that there will be some protection, perhaps just not very long-lived, and we might be in a situation where we need to vaccinate people on an annual basis against this virus.
Pamela Vallely, thank you so much for joining us, University of Manchester medical virologist. Now, we'll have plenty more, of course, on COVID-19. Later on, a conversation with Johns Hopkins professors as we continue to track the pandemic. Now, also coming up on Bloomberg Quick Take, Anthony Fauci, National Institute of Allergy and Infectious Diseases Director. That's live streaming on Twitter, Facebook, and YouTube at 1 p.m. in New York. That's 6 p.m. in London. And this is Bloomberg.
It's such an interesting new world.
The world is changing.
For us, it's not about being first, it's about being the best.
While everyone is zigging, we're zagging.
We feel like we can maybe help people out more.
We have an enormous number of big ideas.
I do double down on helping other Black founders, whether it's fundraising, hiring, growth, product, whatever it is that they need.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
There's going to be more oil supply that's needed. We think there's great value and returns to be generated in oil for the foreseeable future, so certainly the next decade, likely beyond that.
Well, that was BHP Chief Executive Officer Mike Henry speaking with Bloomberg as the company reports earnings today. That will be, of course, dominated by profits from iron ore. Now, staying on the subject of commodities, joining us now is Harry Chilingurian, BNP Paribas Head of Commodity Research and Senior Oil Analyst. Harry, always great to speak to you because you make us smarter about the commodity world. So thank you so much for joining us. How do I look at commodities?
Good morning.
So they've been through, hell in a basket because of COVID-19 and the lockdowns. Do we look at demand from commodities in China to give us a sense on how some of these commodities will gradually recover?
Well, obviously, commodities is a vast world. Some commodities are more leveraged to the economic cycle than others. You were mentioning China. Clearly, base metals, aluminium, copper are going to respond very favorably as China continues to exit ahead of other countries this COVID lockdown situation. And we're looking at the PMI data in China being relatively favorable. But I think even for base metals, it really depends on China being able to export more to its key markets, which are Europe, the U.S., and Japan, for that increase in price to take place. In other markets like oil, for example, there's clearly an issue of oversupply that OPEC Plus is addressing through voluntary cuts. And then, of course, in precious metals, the general uncertainty around an economic recovery and balance sheet expansion by the Fed has sent gold prices to new records. So, again, depending on what you're looking at, the focus sort of changes a little bit from supply to demand to the broad macro financial considerations.
Harry, what do I do with iron ore? So iron ore, of course, used to make steel. It's, we had a record steel production in China, which means that iron ore has surged actually to the highest level since 2014. Can it continue?
I think in terms of China's stimulus plans in general, there's, of course, a lot that's going to be related to infrastructure. And clearly, there's going to be a lot of rebuilding. China's done as well through some flood episodes that are going to require, of course, a lot of work. So I guess from a regional perspective and a focus on China and steel demand, or at least how people perceive steel demand in the context of stimulus measures in China, then naturally iron ore is going to respond. China is also having quite a bit of influence recently in terms of oil prices, with its imports of oil, I should say crude oil, reaching all-time highs. And as a result, up until very recently, supporting the structure in Dubai prices and by extension, of course, onto Brent. So China still is playing that lead role in terms of the contributions to commodity, I'd say industrial commodity growth in general.
Harry, I just went through about 6-7 commodity charts, and then, folks, they're all different. None of them look the same. You've got lumber exploding higher, and there's the discussion of iron ore that Francine said on today. But, Harry, what I find interesting here is the rebound in commodities, if it establishes a new commodity trend out 1 year, 2 years, and 5 years. Can you call that? Or is this just a bounce up to whatever the regression is of a long-term bear market in commodities?
Well, I think we need to be a little bit cautious, and again, you have to sort of differentiate which commodity sector you're looking at. We had a V-shaped recovery in a lot of the sort of soft economic data, the PMI and ISMs. And so people are still trying to figure out what letter the recovery is going to have. Is it going to be an L, a W? Yeah. Some people are going through the square root type view of things.
We don't do square roots on Tuesday.
Of course not. But I think all in all, commodities ultimately in the end are real assets. So the more manufacturing improves, and we're seeing that these soft economic data showing that, you are going to get a bounce back in the industrial complex. The other issue, is precious metals, which is a whole different world, really tied to what the Fed is doing.
Yeah, I'm looking for an entry point on gold. I missed it. I can't find the front door at Tiffany's, Francine. Harry, I look at commodities and all that's going on there, and I say, okay, great. I need to make an opportunity. Australian dollar's already gone on me. Iron ore's popped, et cetera. Where's the opportunity right now in commodities, or is it to go the other way on something extended?
Well, I think there are two cases in terms of the longer-term view in commodities. One pertains to oil, and the other pertains to gold. So in the case of oil, of course, the decline in prices that we were experiencing at the beginning of the year, compounded by the outbreak of COVID, has led to drastic reductions in capex by oil companies. Final investment decisions in terms of projects have dropped. You've seen the likes of BP, Shell, and other majors lower their long-term oil price expectations, which is only going to exacerbate the reduction in capex, and that sets you up for the possibility of a cyclically higher oil price in the medium term. In effect, despite the drive for energy transition and the fact that over the next 20 years we'll be looking at some displacement within oil demand, we still have to incentivize the production of oil, not just to replace what's declining, but what is actually going to grow. So there's a cyclical case. There's a cyclical case for higher oil prices. Now, in gold, of course, a number of people are considering Fed balance sheet expansion. You've seen the break-even inflation measures move rapidly higher in response to that. And people are still thinking that if the Fed were to adopt some form of yield curve control, keeping those nominal rates low, and as the economy picks up again, then the break-even inflations rise, and you have a case, of course, for another rally in gold perhaps next year.
Yeah, the gold chart really something with a bounce back here, 2015 the ounce this morning. Always interesting and informative. Harry Chilingurian of BNP Paribas. Coming up on the DNC, I guess he's the V chair. I think that's vice chair, or maybe it's virtual chair. Garland Gilchrist, he's lieutenant governor of the most important state of Michigan. This will be an interesting conversation in the 6 o'clock hour. This is Bloomberg. Good morning.
does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
This is Bloomberg Surveillance. I'm Rishka Gupta. Let's get your Bloomberg Business Flash. Citigroup's $900 million mistake is facing scrutiny on two fronts. Bloomberg's learned that regulators want to know how Citi accidentally paid the money to Revlon's lenders. Meanwhile, the bank is suing one of the recipients, Brigade Capital, to try to get the money back. The world's largest sovereign wealth fund lost $21 billion in the first half of the year. That represents a 3.4% decline for Norway's wealth fund. A rebound in stock markets wasn't enough for the fund to erase its record drop earlier this year. And SoftBank has bet $3.9 billion on 25 tech giants from Amazon to Tesla. The Japanese conglomerate has invested more than $1 billion in Amazon, its largest holding. SoftBank founder Masayoshi Son is expanding the company's investment activities from private startups to publicly traded equities. And that's your Bloomberg Business Flash. Francine Tom.
Ritika, thank you so much. Now, the race to acquire TikTok is ramping up. Oracle is now said to be considering a bid for the video sharing app. Now, its entry could challenge Microsoft's bargaining position. Well, joining us now for the very latest on some of these tech companies are Bloomberg opinion tech columnist Alex Webb. Alex, thank you for joining us. Oracle is now after TikTok. Microsoft is in the race. Anyone else?
Well, we understand it's been reported by our colleagues Sarah Fry and Sarah McBride that Oracle has reached out to some other parties, including Sequoia, the VC firm on the West Coast, presumably about making a joint bid. It had also been reported that Twitter was involved at one stage, but it's a far bigger ask for Twitter to get involved. They've got a lot less capital to bid for a company which bankers and analysts estimate could be worth between $20 and $50 billion, which is, you know, in about the same as Twitter's own market cap.
Who does it make sense to acquire TikTok? How much does TikTok actually have to transform compared to what it is now, and who benefits the most from it?
I mean, strategically, of those three names, Microsoft seems the most logical acquirer. If you think about the fact that Facebook and Google, they talk about them being the ads duopoly. You know, 2/3 of all new dollars spent on digital ads go to Google and Facebook. Increasingly, Amazon is getting a piece of that. Now, Microsoft already has a social media platform in the form of LinkedIn, and it has an ads business that is delivered through Bing, its search engine. This would help it significantly boost its presence in digital advertising, adding a major new pillar to its business, and possibly try to compete more forcefully with that Google-Facebook duopoly.
Alex, a key question here for me is the ownership, and if you lose the network ability of any given system, if it's partitioned into American ownership and other ownership and Chinese ownership, do they lose the networking advantage of 800 million people together?
I mean, that is a huge challenge here to understand quite how technically it would be divvied up. You know, if you think about TikTok in the UK, for instance, which it wouldn't be part of this this carve out. You know, the understanding is that it would be TikTok, US, Canada, Australia, New Zealand, but the UK would remain in the ByteDance business. Well, you know, if people are using TikTok in this part of the world, they consume a huge amount of content coming out of the US. Does that mean they would not be able to do so going forward?
Do we know that?
Unclear how it's. We don't know how that would work. Now, maybe there's some technical workaround which would you know, alter that, but it is a huge question which remains unanswered and might sort of unpick some of the logic of such a deal.
Well, I mean, but Microsoft, Oracle, and the 48 others that aren't mentioned, I mean, they've got to be asking that question. Who determines that? Who decides that?
I simply don't know. You know, I'm sure that it's also something that the CFIUS and the Trump administration, I'd be very surprised if they thought of a technical solution to that. Ultimately, I think, you know, perhaps is less of a concern, frankly, for, say, Microsoft or the company buying US business, because there is a lot of content created in the US that is then consumed in the US. The greater concern, I think, would be for the almost legacy business or the rump that remains within TikTok. It's within ByteDance, within the parent company ByteDance, and their ability to consume content. You know, are people just going to consume UK creators in the UK? Probably not going to see consume French creators. And then the issue becomes the ability of a creator in, say, France or Germany to go onto that platform and find a US audience gets diminished.
And yeah, to me, folks, that is fascinating. Alex, that was brilliant. Thank you so much. Alex Webb, always smart on technology there and the network effects of separating out any given platform, including TikTok. Coming up, Stephen Roach. This is really, really timely to talk to Dr. Roach about China, always, but to talk to Stephen Roach about the dynamics of the economy that we're in, on the income statement and on the balance sheet of the world. Please stay with us. Another hour of Bloomberg Surveillance.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
This morning, the dollar, it is weaker against the euro and yen. Bonds are bid. Boeing, they will execute a, quote, voluntary layoff. Marks & Spencer will eliminate 1 in 10 employees. So much for the V-shaped recovery. Yet housing, it booms. As the WFH employed, they migrate. Housing starts and permits. Look for that at 8:30. And ideology be damned, Democrats and selected Republicans asked the nation to make President Trump a one-term president. Meanwhile, Vice President Pence tweets, well, of a record close for the NASDAQ. Good morning, everyone. This is Bloomberg Surveillance from New York, from London. Tom Keene, Francine Lacroix as well. Francine, what an interesting dilemma we've got across this world on a virus that won't go away. You've got New Zealand delaying their elections. You've got New Zealand with a little bit more caseload. Germany, I know, is in pandemic as well. Here, the University of North Carolina has aggressively switched their plans as well. This virus, this is a continued top story.
Yeah, and I have to say, Tom, for example, testing here in the UK is very, very high. It's quite easy to go and get a free test through the NHS. I think they test about 3 times than other European countries, but France and Italy over the weekend closing some of their, dance clubs, and the UK keeps on putting countries almost one after the other on quarantine. So it's also, an interesting debate on how you look at the metrics and when you think it's safe or not to travel to another country.
Yeah, well said, and it's really something, folks. For those of you in America, the dynamic in Europe is radically different, and this is a real free-flow story here in the middle of August. Right now, with our first word news in New York, here's Ritika Gupta.
Morning, Tom, Francine. Michelle Obama described President Trump as unfit for office on the opening night of the Democratic Convention. The former First Lady blasted him for mishandling the pandemic.
More than 150,000 people have died, and our economy is in shambles because of a virus that this president downplayed for too long.
Obama said that Trump is clearly in over his head. President Trump added a trip to Iowa to his schedule today. His support has been slipping in a state he won by 9 percentage points in 2016. Polls now indicate Iowa is up for grabs in the race with Joe Biden. China is denouncing the latest U.S. limits on Huawei technologies. Beijing calls them nothing short of bullying. The Trump administration moved to curb Huawei's access to commercially available chips. Its goal is to prevent adoption of the company's 5G technology. President Trump told Fox he doesn't want Huawei's equipment here, quote, because they spy on us. And in Canada, Finance Minister Bill Morneau has resigned after a rift with Prime Minister Justin Trudeau proved impossible to repair. That leaves Trudeau with a major hole in his cabinet in the midst of a recession. Bloomberg's led Morneau's replacement will not be former Bank of England Governor Mark Carney. Carney has been advising Trudeau on an economic recovery plan. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom, Francine.
Ritika, thank you so much. The dollar's weaker, futures up 5, and I'm going to do a data check now, which is simply the remarkable story of Home Depot. We all know this story in America. We're all stuck at home. We're on the internet, and I guess we're buying from Home Depot. The number one headline, without question, is the average ticket price is up a stunning 10.1%. I believe I've never seen that. I stand corrected if I'm wrong on that. Same-store sales are unimaginable, up 23.4%. I really don't know what to make of that number. Oliver Chen's scheduled to be with us. He's more on clothing retail, but nevertheless, big box Home Depot, just as phenomenal. Earnings of 402 versus an estimate of 366. There's something really going on here when you see comp sales. The estimate of comp sales was up 11%, and Francine, they came in up 23%. This again, Francine, may be like what we saw with the Apple juggernaut of weeks ago, is just testament to the changed America.
Yeah, and it really goes to the fact that maybe, as people are more at home, some of them have more time. I've been building desks, Tom, in record time. I just wanted to put it out there because it was no mean feature, and it was pretty hard to do. European stocks are actually edging higher. U.S. equities also, U.S. equity futures also higher. And investors seem to be looking past these fresh tensions between Washington and Beijing over Huawei, and they're focusing on maybe more opportunities out there in the markets. The dollar gauge sliding to the lowest since 2018, and then I wanted to also show you what gold was doing because it's above 2,000, Tom.
Very good. My fondest hope would be a 4 4-hour conversation with Dr. Roach. That's not going to happen today. Stephen Roach of Yale University with us too briefly. And because of that, Stephen, I want to get away from a lot of questions on finance and the Fed and simply over to the unbalanced. And that is the relationship now of Beijing and a future Washington. The Roach book is Unbalanced, the Codependency of America and China. Stephen Roach, your thoughts on Trump, Biden, and Beijing. What will come after the election, whoever wins?
Well, it's two different answers, Tom. If under Trump, the relationship has been purely politicized as a means to deflect voter attention away from his malfeasance on dealing with the coronavirus. We know this clearly from strategy documents written by Republican consultants that were leaked in Politico in April, the so-called Corona Big Book. I urge you to look it up. It says very clearly, when it comes to the virus, do not defend Trump. This was in April, by the way. Instead, attack China. And as the president's malfeasance has grown to epic proportions, the attacks have increased dramatically. And so my point is, do not extrapolate what you're seeing in terms of Trump portraying and his minions portraying China as an existential threat. This is crass political theater. If he's reelected, Cold War will be